Hi, and welcome back to the Business Career College video series. In this video, we're going to look at sort of a higher end financial planning concept. This is what we call the capital dividend account. And if you're going through the life license qualification program, you should have sort of a surface level awareness of CDA. If you're going through any of the financial planning courses, then the CDA is something you should be more familiar with. What the CDA is, the capital dividend account, it is a notional account. And notional simply means that it's not represented with real dollars. Think of this in a similar manner to your RRSP deduction limit, which is also a notional amount. That is, every year you get your notice of assessment, and your notice of assessment says for 2013, your RRSP deduction limit, your unused amount is, let's say, $7,200. Well, that simply means that you can put up to $7,200 into your RRSP for that year and deduct it. It doesn't mean you actually have that $7,200. That's very similar to CDA. CDA is a notional account. That means there's not necessarily real dollars behind it, but it does represent the ability to do something if you have those real dollars available. So you're not going to go open a bank account at Bank of Montreal or whatever the case is that's called your capital dividend account. It's simply a notional account tracked based on some amounts paid into your business. So there are two fundamental ways that a CDA can be created, and then sort of a couple of other ways that we can create a CDA. But basically, the big ways we create a CDA are, first off, and most important for our purposes, a life insurance death benefit paid to a corporation. So this account exists only within a corporation. And in this case, the amount of the CDA credit is equal to, the amount of the CDA credit is equal to the total death benefit paid minus the adjusted cost basis for that policy. So if you have a nil adjusted cost basis or a zero adjusted cost basis, as in a term policy or as in most T to 100 policies, this is not a concern. But if you have a UL or a whole life policy which has an ACB, that's going to reduce your CDA credit. And the reason for that, it's a fairly complex reason, but the reason is really this prevents somebody who's sort of near death or terminally ill from dumping a bunch of money into their policy, which would increase the ACB, from then planning to die and having their death benefit now allow them to pay this tax-free amount out of the capital dividend account to their estate or to their heirs. So it's really, this provides sort of an anti-dump-in provision. Now, this does not apply for living benefits products. So a CI policy or a DI policy does not create any CDA credit. So this is not applicable to living benefits policies. That's an important distinction. It's only life insurance that creates this type of CDA credit. And the other way, the other big way that we can create a CDA credit is through the tax-free portion of capital gains. So as you're probably well aware, a capital gain is only half taxed. So if my corporation, and again this has to happen within a corporation, if my corporation disposes of property, and let's say we have a $100,000 capital gain on that property, we'd say, okay, out of that 100,000, 50% of it, that is 50,000, is taxable, and it's taxed at fairly high rates, close to 50% depending on the province that you're in. Corporations are generally taxed at a fairly high rate on their investment income, but the other $50,000 is going to create a CDA credit. So these two things can both create a CDA credit. Now there are some sort of overarching rules here that we do have to concern ourselves with. The overarching rules are that this only applies to private corporations. Publicly traded companies don't have CDA accounts, and it has to be a Canadian controlled private corporation. So Canadian controlled means that the shareholders who own the voting shares reside in Canada. It's a fairly complex set of rules, but you have to recognize here that does apply to Canadian controlled corporations. Now, the other thing that we should mention while we're on that topic is that the CDA credit can be transferred from an OpCo. If the OpCo has a CDA credit, it can transfer that credit to a HoldCo, or in any kind of this subsidiary structure, the subsidiary can transfer that CDA credit up to its owner. So a CDA credit can transfer freely this way. Okay. So now, what does this CDA credit let me do? Well, let's say that we have a key person life insurance policy. So we have a key person policy on a manager. So we have key person life insurance owned within the corporation. And let's say it's just term insurance. We have let's say a term 20 policy. And let's say it's a $200,000 face amount. And unfortunately, as you might expect, our manager, the key person here, dies. Sorry, manager, it was inevitable, I guess. And that means we have a $200,000 death benefit paid to the corporation. So presumably we use that death benefit to pay some of the expenses associated with this person's premature death. We have to hire a new person, or whatever the case is, we have to go and replace them. So this money is spent. The money's all gone. But what happens when the money is paid to the corporation is we do have this $200,000 CDA credit. Now, as with any death benefit, this amount was paid to the corporation tax-free. So that's easy, and that's exactly what we would expect. That death benefit was paid to the corporation tax-free. We've spent the money, but we still have this $200,000 CDA credit. So let's say some years later, after we've recovered from the death of this key person, so the business has recovered and it's making money again. So let's say whatever amount of time you want to pick, 3, 5, 10 years later, I don't care what the time frame is, the corporation has an extra $200,000 laying around. Now this will be an extra $200,000 of after-tax money, so we have an extra $200,000 of after-tax money. Normally, if we want to get this money out to our shareholders, we'd have to pay it out to them as a taxable dividend. That is, they would get that money and it would be subject to the dividend gross up and dividend credit regimes. But in this case, because we have this CDA credit that we've never used, we're now going to take this $200,000 and we're going to pay this out as a tax-free capital dividend to our shareholders. That is, the corporation just writes a check for $200,000. The shareholders get that full $200,000. They don't have to pay 1 cent of tax on it. You can see here that it's a fairly strong tax advantage, but it's a fairly rare event at the same time that the corporation actually has this death benefit paid with relation to a policy that it owns. It's a good reason to have life insurance owned in the corporation, and certainly from a tax planning perspective, it's fairly powerful. I hope that helps to understand the capital dividend account. There's a lot more complexity to it, but on the surface, this is sort of what you need to understand. If you're going through the LQP, just a surface level understanding, probably watching the video once is good. If you're going through one of the financial planning courses, then you'll need to understand this in more detail, and you really should be doing some further investigation into the CDA. I hope that helps. and enjoy your continued studies.